Welcome to The Explainer. Today, we're jumping right into the crypto crash of January 2026. This was a day that sent some serious shockwaves through the entire market. So let's get into it and break down exactly what went down. Okay, so get this. In just one single day, the crypto market just got rocked. Over $100 billion in value. Poof, gone. And we're not talking about a slow decline here. This was a sudden, absolutely violent event that caught so many traders completely flat-footed. And the craziest part? This catastrophic loss all happened in less time than your average workday. In just a 5-hour window, pure panic set in, automated sell-offs kicked into high gear, and billions were just wiped off the map. So the big question is, what happened, and why did it happen so incredibly fast? Well, this was no random market correction. It was a reaction to a perfect storm of events, and we're going to unpack every single one of them. You see, this crash wasn't caused by just one thing. Nope, it was a convergence of 5 really powerful forces hitting all at the same time. It started with a macro shock from the Fed, which led to institutional panic, a massive leverage unwind, and then a major technical breakdown in price. First up, that macro shock. The surprise nomination of Kevin Warsh to lead the Federal Reserve sent a jolt through the markets. Now, this guy is known as an inflation hawk, basically someone who likes to raise interest rates to keep inflation in check. His appointment immediately made people think the era of easy money was over. That makes the US dollar stronger, and when the dollar looks like a safe bet, investors, well, they tend to run away from high-risk assets like crypto. Second, the very thing that was designed to bring all this big institutional money into crypto suddenly became a high-speed exit ramp. We're talking about spot Bitcoin ETFs. They were once a huge part of the bull market, but all of a sudden they became a massive source of selling pressure. And the scale of this exit? It was absolutely staggering. On one day, January 29th, big institutions pulled over $817 million from the major Bitcoin ETFs. Giants like BlackRock and Fidelity saw huge redemptions. In fact, it was the largest single-day outflow since these funds ever launched. And this wasn't just a one-day blip. It marked a stunning reversal of a multi-year trend. After 2 straight years of massive institutional buying, 2026 was the first time the net flows for the year actually turned negative. That just kicked a key pillar of support right out from under the market. Third, all that selling triggered a just devastating cascade of forced liquidations. See, as prices dropped, all those traders who had borrowed money to bet on prices going up got completely wiped out. In just 24 hours, exchanges automatically slammed their positions shut to the tune of $1.8 billion. And that, of course, just threw gasoline on the fire, accelerating the whole downward spiral. Fourth, we got a super clear signal that investors were just not feeling risky anymore. While Bitcoin fell about 6.5%, Ethereum plunged nearly 12%, almost twice as hard. Whenever you see ETH get hit that much harder than Bitcoin, it's a classic sign that people are fleeing from the riskier stuff and running for the safety of cash or stablecoins. And finally, the whole technical picture just fell apart. Bitcoin crashed right through its critical price floors at $82,000 and the big psychological level of $80K. At the exact same time, it was moving in lockstep with falling stock markets, completely shuttering that story about it being a safe haven asset. But here's where it gets really interesting. Amid all the panic and the scary headlines about a crypto bloodbath, some data started telling a very different, almost backward story. Yeah, so the analytics firm Sentiment pointed out that the crowd's sentiment had just plunged into extreme negativity. And historically, when fear gets this high, it often marks the point of maximum pain, which is often right before a market starts to recover. It's that classic be greedy when others are fearful idea. And that leads us to a really crucial question. What if the entire market's panic about Kevin Warsh and a more aggressive Fed? What if it was all just a massive overreaction? What if the data was actually pointing in the complete opposite direction? This is so important. While stocks and crypto were selling off in a panic, the bond market, well, it seemed to disagree. The 2-year Treasury yield, which is a key signal for what the market thinks interest rates will do, actually fell. That is the exact opposite of what you'd expect if everyone was bracing for higher rates. Some analysts started arguing that maybe, just maybe, Warsh might actually cut rates sooner than everyone thought. This whole conflict really illustrates the duality of crypto, doesn't it? On one side, you've got this
devastating, terrifying short-term risk. And on the other, you have a massive, long-term vision that remains totally unshaken by these violent swings.
So on one hand, you've got the catastrophic paper loss of a single firm, Tom Lee's Bitmine. They made a massive, concentrated bet on Ethereum, and it resulted in an unrealized loss of nearly $7 billion. Their stock collapsed over 80%. I mean, this right here is the face of a short-term crisis. But on the other hand, the long-term believers are looking way, way beyond this crash. They're not focused on tomorrow or next week. They're looking at a horizon that's a decade away, where they believe the fundamental value of all this is going to win out in the end. And the core of that whole long-term idea is the digital gold narrative. It's the belief that Bitcoin will eventually fulfill its destiny and become the main superior store of value for our increasingly digital world. The argument is actually pretty straightforward. While gold has literally thousands of years of history as a safe place to park your money, the Bitcoin advocates will tell you it's technically superior in almost every single way. It's got absolute scarcity, it's easier to divide, it's easier to move. Of course, the counterargument is that you can't just code history and trust. Gold has a track record that spans millennia, while Bitcoin is still proving it can handle global economic shocks, like this very crash.
So, as the dust starts to settle from this thing, here are the critical signs that are going to tell us where the market is headed from here, whether we're in for a quick recovery or a much longer downturn.
You're going to want to keep a close eye on three main things. First, the daily ETF flows, because that'll tell you what the big institutions are thinking. Second, the critical price support levels, like that $75,000 mark for Bitcoin. And finally, the major economic data, like CPI and jobs reports, because that's going to influence what the Fed does next. And all of this leaves us with the $17 trillion question. Which is the potential market cap some people see for Bitcoin in the next decade? Is this brutal crash just a short-term fever break, something that shakes out all the excess before the next big run-up? Or does it expose a fatal flaw, proving Bitcoin just can't stand on its own 2 feet when things get stressful? The answer to that question is going to define the next chapter for all digital assets. Thanks for joining us for this explainer on all the powerful forces at play here. We'll see you next time.